let's get back to the markets and your money and bring in two guys you know, Guy Adami and Tim Seymour, and we're glad you guys are here with us. You know, Guy, listen, I tweeted out sort of only half-jokingly that this was maybe at the end of the day the best feeling 6% drop that I'd ever seen. Of course, you don't see many 6% drops, but was anything about the price action in the last 30 minutes to an hour giving you any reason to be a little bit more optimistic?
Well, it's better than, dropping an additional 6% of where we are. So, yes, it was, given the choice, it's better, and I am somewhat optimistic. Not that levels matter at all, but I think a lot of people have talked about that 2350 or so level. I think I heard Bob Pisani mention it. So the fact that we closed above it is encouraging. What I'll be more encouraged by, and I'm sure Tim has thoughts on this as well, is, again, if we can somehow, if the volatility in the Treasury bond market were somehow start to wane, and whatever the level of stability is, and I'm not suggesting I know, but if we can sort of get there and find stability, I think that's when the stock market can find its footing. If you remember back in February of 2016, I want to say it's February 8th, I don't remember the exact day, but if it was the day the S&P traded down to 1810, that day after the market closed, we got three pieces of news. We got news that Jamie Dimon himself was buying J.P. Morgan stock, and I think at the time the stock was about $54 a share. I think we got some news out of OPEC, which was somewhat bullish for an oil market that had been cratering, and we had some sort of bond offering with Deutsche Bank. And I think those three things in confluence put a floor in the market. I think what you really want to see, short of Mr. Buffett announcing something, is some of these CEOs, not the corporations buying back stock, but some of these CEOs putting their money where their mouth is. I think that would give people a lot of, I think it would give them some encouragement.
Yeah, some encouragement, Tim, right? Would you agree with that? Just step up, get out there, and buy your own equity.
Well, certainly is a place where equities are looking attractive relative to just multiples that they've traded at for the obvious reasons. The things that we need to see, though, are the mass liquidation that's been going on in the market is a function of where investors came into this with bigger balance sheets. I mean the professionals, and I mean also the retail investor. The gross in the market was massive. From the Fed on down, there's encouragement to take liquidity. What we're seeing now is markets need to simplify. Investors need to simplify. But more importantly, the gross is coming down. Some of this is forced liquidation. Every single asset class was down massively today. And that tells you. And the dollar, meanwhile, has moved 7.5% in 7 days. And what at one point was the dollar trailing off at the first sign of this is now showing a flight to quality. The implications for this, unfortunately, are devastating for anybody that's holding essentially foreign currency debt. We've seen currencies around the world blowing out. But again, as Guy talked about, the Treasury market off another. Treasury market's off almost 5 points on the 10-year note in 2 days. And that's extraordinary. Copper down 7%. Oil you talked about. So this is clearly, people being forced to delever and those understanding that cash is probably the best place to be.
You know, Guy Adami, we had Bill Miller on the exchange today, and he was talking about this is a buying opportunity. Bill's a long-term investor, one of the, if not the most successful active managers ever outside of Mr. Warren Buffett. He came on and said he thought it was a buying opportunity. I want you to listen and respond, sir. Here you go.
There have been 4 great buying opportunities in my adult lifetime. The first was in 1973 and 74. The second was in 1982. The third was in 1987. And the fourth was in 2008 and 2009. And this is the 5th one. So I think this is an exceptional buying opportunity. I don't mean to put all the money in it at once, but I do think layering it in right now is the way to go.
Do you agree with that? We lost. Well, I mean, do you think that this, and you're not calling a bottom. No one's asking Guy Adami, say today's the bottom, whatever it is. But can you dollar cost average your way out of this over the next couple of years?
Well, who's he calling it a bottom for? I mean, I think, respectfully, a lot of people at home right now are not necessarily worried if it's a buying opportunity for stocks. They're trying to figure out, quite frankly, what is my job going to look like in a month from now? So I think there's a very good chance that within however many percent, he's making a lot of sense. But I think the real issue for folks is, we need some stability, we need some calm, and we need the powers that be to sort of assuage a lot of the concerns that are not just necessarily, Apple's going from $323 a share to $240 a share. And I'm trying to keep it real. So I respect him a great deal, but, can I comment on that? I appreciate what he's saying, but I think, right now there are bigger fish to fry.
Yeah, and I think, Tim, you look at his comments and you think, and what he said is people are being forced to liquidate. When you hear terms like forced liquidation, you said it as well, that means things that have more value maybe down the road are being dumped out. And right now, nobody has any idea what that is because everybody's running down the same street.
Yeah, and again, Bill Miller, who's got a track record to prove it, and a friend of our shows. But I mean, long-only managers, sometimes there's an opportunity to be buying weakness, and there's a lot of folks that don't have the ability to buy weakness here. And I think that's part of where the fear is. Look, there as we've seen in the market today, there were individual names of companies that I think ultimately the market made assessments either of where their business model is going to be both now and right after the end of the near-term part of the pandemic. And then also, you have to be looking at every company based upon a leverage profile that you think you of now. But again, we're talking about companies that may not have revenues coming in any meaningful way. I mean, obviously, the airline industry is of an extreme, but there are a number of different industries where if you look at, and Cowen's done some great work on this as it relates to some of the airline industry, you're not going to see them get back to 2019 actual revenues until you get into 22, 23. Yeah. So the leverage profile is critical. The credit markets are talking right now. The leverage loan market was down 10 points day over day. And this is the part that should be, I think, where a lot of investors should not be weighing into companies where they can't understand the profile, even though they're down dramatically. Cisco, which ended, their fiscal quarter with $13 billion in cash, and trades at probably, a 13 or 14 times free cash flow yield, has a balance sheet that I think is pretty interesting. But Apple has a balance sheet that's pretty interesting. And those are names that I think have been more resilient. If you look at some of the other, the Chinese internet names, and I mean, not, going down the curve, just look at Alibaba and how resilient that stock has been. So I think that's how you have to be navigating the environment.